Awesome. I appreciate it, gentlemen.
Yep. All right, so I'll share my screen here quick, but so as I was saying, we appreciate the partnership, and I've been in the M&A world, business valuation, for close to 7 or 8 years. So I'm not quite as in the weeds in the accounting world as Jimmy is, and I'll let Jimmy give his introduction and take it from here.
Hi, everybody. My name is Jimmy Burgess. I'm in the Client Accounting Services department here at Lutz, and I work with a lot of small business owners. I like to kind of describe our department as kind of like an accounting back office. We help a lot of clients that need some sort of accounting support, whether it's kind of down at the lower level or at a higher level, such as data analysis, help with some controller, CFO tasks. We kind of try and fill the gaps with our clients that may needs anywhere along that spectrum of services. I also work with a lot of new companies that we're onboarding. They kind of are going through the growing stages of getting their businesses up and running. And so today I kind of wanted to just talk through as it relates to cash compensation for startup companies. What are some things that you need to take into consideration for employees that you're going to be hiring and paying? In addition to that, if you're going to be paying independent contractors, what are some of the things that you need to take into consideration from that standpoint as well? Going to go through and kind of just discuss wages, what needs to be done prior to paying your employees, just some of the general ideas of some things that you're going to want to address to kind of discuss applications, things like that you need to take care of prior to paying your employees. And then also the compliance piece for independent contractors. What are some things that you need to do from that standpoint as well? For cash compensation, big advantages for that for the payee is obviously the immediate benefit. You're getting a paycheck. It's good for your payee, for the employee, person that's receiving the money. The other advantage is the avoidance of risk. You're getting that money upfront right away. It's not something that's an equity or stock or something like that you're not really getting the benefit right now necessarily. In addition to that, it's going to be an immediate tax deduction for the company. So that's the other advantage to cash that's getting paid out towards employees and independent contractors. Disadvantages, it's going to be reducing your working capital, which at the business growth stage, startup stage is hard. That's your baby, trying to control that. And so that's the piece of cash compensation that can be difficult, which is why this works hand in hand with some of the stock and deferred comp that Michael's going to be discussing. And then also the compliance piece, which a lot of people are not really excited about. Handling payroll tax returns, payroll tax deposits, everything that goes along with payroll. It's not the most fun thing in the world, but there's some things that you can do to kind of get yourself on the right foot going forward, so it's not a problem for you going forward. Just in general, an explanation is that an employee is anyone that performs services for an employer if the employer controls what will be done and how it will be done. It might seem obvious for some, the explanation, but when we start talking about an employee and an independent contractor, there's some gray area there because there is a incentive sometimes to treat people that you're paying as an independent contractor instead of an employee, and the IRS is kind of keeping an eye on that, I guess is the best way of putting it. So conversely, for an independent contractor, payer has the right to control or direct only the result of the work and not what will be done and how it will be done. Now, there's a lot of different things in detail that we'll kind of discuss in a few minutes here, but this is just a general explanation, to kind of distinguish the two different types of people that you're going to be paying as a new startup company. Wages, commonly you would think of as just salaries, hourly wages, overtime pay. I will specify that even if it's temporary, that's still considered wages. So if just because you're paying somebody for a month, and if they're an employee, then they need to be treated as an employee and not as an independent contractor. Employee business expense reimbursements, if not part of an accountable plan, are treated as wages, taxable wages. And kind of an example of that would be if you're reimbursing your employee for a cell phone. Well, if they don't use a cell phone on the job, then it's not part of an accountable plan. It doesn't have any sort of business connection, which is kind of that first line item underneath there where there's 3 rules for the accountable plans. As I mentioned, the business connection, substantiation of deductible expenses, and timely return of excess payments. And an example of a proper accountable plan would be mileage reimbursement. If you've got people that are working for you that you're reimbursing them, they have to drive for work, so they have a business connection. They are keeping track of a mileage log, so that is a way that they can substantiate their deductibility of their expenses. And then if you're reimbursing them for the mileage rate, if they're driving less miles than what you're reimbursing them for, then the employee needs to reimburse the company for those excess payments. So in general, it's about 120 days from time of being paid that those reimbursements need to be repaid. But as long as the expense reimbursement plan follows these 3 rules, then you can treat it as non-taxable compensation. Other wages would be supplemental wages, anything that you're getting that's not like bonuses or severance pay are a few examples that are not normal compensation that you're getting for the pay period. Other things would be taxable fringe benefits. Common one there is personal use of company auto. People are using a business vehicle. It needs to be included on their W-2 because they're getting the benefit of using a vehicle, but they're not actually getting the cash paid to them for that. And so that's a wage that needs to be included on their W-2. Just something that we work with clients usually on at the end of the year to make sure that the supplemental wages, taxable fringe benefits are all getting included properly on their employee W-2s. As I mentioned, for supplemental wages, it's really defined as any compensation paid in addition to an employee's regular wages. One thing to take into consideration is that with supplemental compensation, the withholding rates for federal withholding and state withholding are different. That's why we like to make sure that we have the 2 distinguished. If you're paying out a bonus, it's the withholding that's going to be taken out of that paycheck is going to be different than if it was just a normal monthly paycheck. And that rate for federal purposes is 22% and 5% for Nebraska withholding. That's just important. Anybody that's helping you with your payroll processing, that's going to be something that they should be knowledgeable about. But it's something to keep in mind when you get to the point where you're starting to pay commissions, bonuses, to understand that there are some different rules that apply for payroll purposes. Some key things to keep in mind before you start paying your employees. The first is determining the type of tax entity that your business is going to be. Depending on what the structure is of your entity, you're going to have either owners, members, partners, or stockholders. And from their purposes of compensation, it's going to be different. It's going to depend on what type of entity, tax entity that is. And I mean, single member LLC or partnership or C Corp or an S corporation are all different types of entities. And the compensation for owners of those types of entities is going to be different depending on what they are. This should be a discussion that you're having with your accountant and attorney, prior to starting the business so that you know which direction you're going to be going. Because that will really impact how owners are going to be getting money out of the business apart from how they're going to be paying their employees. Once you've determined what your entity is, likely your attorney has helped you, but you'll need to apply for an EIN. We also recommend getting an EFTPS account, which is the federal website online where you can actually log into your account and view your payroll tax payments, deposits. If you're going to be outsourcing your payroll support, you're not going to need to get onto this account to initiate any payments or anything like that, but it's helpful to have access to this account so that you can always get on and verify that your deposits are being made on your behalf. And if anything comes up where you're switching from one payroll support provider to another, you've got access to this account so that you can initiate any payments if necessary. But that's just a recommendation for us. Once you have the EIN, you'll want to apply for your state withholding and unemployment tax accounts. And I say if applicable because it just depends on the state that you're going to be working in. I presume a lot of you would be in Nebraska. So Nebraska has state income tax. They also have unemployment tax that employers have to pay on employee wages. So you would need to apply for state withholding and unemployment tax accounts in most cases if you're working in Nebraska. Things that you're going to want to know is where your employees are going to work to determine which states that you're going to need to apply in. Now, in the age of post-COVID, there's people working remotely in other locations. So you may be in a situation where you have somebody working remotely for you in another state. Rules for each state are going to vary. So when that comes up, it's best to consult with a professional or an accountant just to get their take on what you need to do for your employee that may not be living in Nebraska, that's not working in Nebraska. You may need to apply for a withholding account in that state or an unemployment tax account and submit payroll tax returns for other states excluding Nebraska. Other than that, it's important if you've ever worked for anybody, you've been requested to fill out a W-4 or an I-9, hopefully. And as an employer, now this is something that you're going to need to be doing for your employees. It's important to get that information because the W-4 is going to help you determine the federal withholding that's going to be taken out on your employees' paychecks. It's going to give you information like their social security number, and you're going to want to keep that on record. The Form I-9 is more of a employment eligibility verification form, but it's required and something that you're going to want to make sure that you take care of for your employees as you get going. As it relates to managing cash compensation for your employees, we highly recommend outsourcing it. A few examples we work with a lot is QuickBooks. Gusto is another one that we've had some success with, and ADP and Paychex. And I'll say that the price range between all four of those is going to be different, with ADP and Paychex being on the higher end and QuickBooks going to be on the lower end. But from the outsourced standpoint, it's definitely worth paying to have somebody help you with this because the penalties and fees for payroll related problems are higher than anything else. And really the way the IRS looks at it is if you're not making your payroll tax deposits timely, then you're really not paying not only your taxes, but somebody else, your employees' taxes that you're withholding from their pay late. And so that's why they really bring down the hammer on the penalties and fees. So it's definitely worth your money to go a route of trying to outsource it. QuickBooks is going to be a little bit more legwork on your end, probably, of just getting things set up. And then, ADP and Paychex is definitely going to be more of a hands-off. They're going to take and run with pretty much everything for you. But they'll handle processing your payroll, remitting all your tax deposits, and filing all your payroll tax returns on your behalf. And it really is easy to mess up and it's hard to fix. So that's just another reason why we recommend outsourcing it when you can. because it's definitely worth doing that. As it relates to people that you're paying that are not employees, and I say this would be independent, another option would be independent contractors, and there's a distinguishing factor between, you know, what an independent contractor is versus what an employee is. And as I mentioned on that first slide, it really depends on who's controlling the work. But if you've come to the determination that the person that you're working with, you know, is not an employee, they're actually an independent contractor, then if you're paying them for services of $600 or more during the year, you may need to issue them a 1099. And 1099s are issued to individuals, partnerships, or limited liability companies. Now, limited liability companies can be confusing because an LLC can be taxed as a partnership or as an S corporation. And for 1099 rules, S corps are exempt from getting 1099s while partnerships are not. So we always recommend that folks, before they start paying their subs or independent contractors, that you get a form W-9 from them, which provides their tax ID information, what type of entity they are, and their address. It's good to do that before you make payment, just because it incentivizes them to complete the form for you versus trying to track these down at the end of the year when you're trying to file these 1099s before the January 31st deadline. But that W-9 was very helpful from the LLC standpoint, where you can't really tell if it's a partnership, if it's taxed as a partnership or an S corporation, if you're.
Okay, so back to the presentation. So RSA is a form of compensation by which the employee is granted actual shares of stock in the company that are initially restricted but gradually vest. So technically, an RSA doesn't really require compliance with 409A, simply because there's no strike price or base price as in a SAR, which I'll get into next. But what's most common with the RSA is the election, or the Section 83B election, which basically means that the recipient of such restricted stock awards can elect to pay taxes upfront rather than as the shares vest. So the idea here is that when the RSAs are awarded, the fair market value of the stock is probably going to be much lower than the value as the shares vest, as the company grows, as hopefully is acquired one day. So as an example, so let's say here in this example, in conjunction with the Series A capital raise, company XYZ grants 300,000 RSAs to employee B on January 1st of 2022. So like I mentioned earlier, a common vesting schedule is a 3-year vesting plan or a 4-year, but in this case, we'll say it's 3-year vesting, and 1/3 of the shares vest on the 1-year anniversary of the grant date. So as of January 1st of 22, 0 vested shares, 300,000 non-vested shares. Fast forward 1 year, 1/3 of those shares have vested, and then only 200,000 are non-vested at this point, or restricted. And then after each month goes by, the more shares become vested until the 3-year anniversary of the grant, when the holder will have 300,000 vested shares and no unvested shares. So just at a high level, from a tax perspective, if the employee files an 83B election and pays taxes on the shares at the date of grant, so in this case, the 300,000 RSAs are granted when the fair market value, 1 share of common stock is $0.25. So they technically have reportable taxable income by filing the 83B election of $75,000. In this hypothetical example, it's a combined federal and state tax rate of 30%. So they don't technically realize any actual cash compensation, but they can recognize $75,000, but they have to come up with the cash to pay the taxes of $22,500. Fast forward, in this case, let's say this company sold in 2026 for $10 a share. generally speaking, only capital gains taxes will be applied to the growth in share value. So your basis will be 25 cents a share. Your sale price is $10 a share. So the difference, that $9.75, is kind of your net proceeds. So yeah, gross proceeds of $3 million less your estimated tax, the capital gain of 20% on the gain, and it's a favorable tax scenario rather than having to have paid taxes, ordinary income taxes, each period the shares in fact vest. So that's the benefit of the 83B election, which, like I said, has to be made within 30 days of the grant date. And the difficulty with the 83B is, the company or the employee needs to know the fair market value of one share of common stock as of that grant date. And the third example of stock compensation is a stock appreciation right. So this is a form of compensation without actual stock ownership, by which the employee compensation is linked to the appreciation in stock value. So rather than the restricted stock award or the stock options, which are dilutive to the company, this is basically a phantom plan in which the employee can realize the upside in value that they help grow, and the company is forced to actually issue shares to them. So at vesting, the company can elect to pay the employee in cash, or they could, in theory, issue stock, but that's not very common. Like I said, that's vesting, which usually requires a schedule. So does the award of a stock appreciation right require compliance with Section 409A? The answer to that is yes. So similar to a stock option in which we have, a exercise price. In this case, 409A comes into play with the idea of the base price. So I'll get into it in my next page, but the base price of the SAR at grant date must be greater than or equal to the fair market value of the stock at that date. In other words, the right can't be in the money as of the date of grant. Similar example, so in conjunction with the capital raise, the company awards 5,000 SARs to employee A. So the base price for the stock appreciation right to comply with 409A has to be at least equal to or greater than the fair market value. So in this case, the fair market value of the share of stock as of the grant date is 50 cents. So the base price is 50 cents. In 3 years, let's say company XYZ is sold for a price equating to $7.50 per share. There would be a tax due, but it's based off the sale proceeds to this employee, which is $7.50 per share less the base price of 50 cents, and that would be the estimated federal and state ordinary income tax of 30%. I don't mean to have so many disclaimers, but whenever we have a tax situation such as this, there are many variables, and it's hard to always give it hard and fast. Capital gains apply, or ordinary taxes apply. So these are just kind of general examples for the tax implications to an employee with these different plans. And lastly, we're going to kind of go into some of the the accounting treatments, more in Jim's world in terms of the debits and credits on these types of stock compensation plans, but it's pretty complicated. There's a lot of FASB rules in terms of how these things should be accounted for. You have to give consideration to the actual, monetary benefit received at the grant and the vesting dates and the fair market values of the stock at those points as well. So we didn't want to get into that, in this presentation. But with that, like I said, we apologize for getting kicked off there, but we're happy to stick around and answer any questions that anybody has.
Well, thank you guys. Yeah, if there's any questions from attendees, feel free to drop them in the chat. Mike, I would ask you maybe some either common pitfalls you see for a company joining a startup when there's stock compensation involved, or a founder for the first time going through the experience of, there, like you said, there are a lot of options there, selecting what is the best route to use stock stock compensation as a long-term motivation?
Yeah, I think, something that we've seen, not necessarily firsthand, but I think the idea of rushing into something like this is not, that's not the best approach to take. So getting on the phone with an attorney that has a lot of experience with startups, or an accountant that does, it's best to work through, what are your goals? And then, what are the goals of the employee? They may not want the actual stock ownership, where they're okay with having a phantom plan, and not technically being an owner. So I think being on the same page as the employees, which can be difficult given if they're definitely an expert in the software field, they may not know exactly what they're looking for, what's the best case scenario for them. But being able to present the employee with favorable opportunities that the company can work through as well. I think that's something that we've seen, that it's helpful to have the legal advisor and the employee and the company be on the same page.
Maybe a question for Jimmy. You kind of hinted at this, of ways that an early stage company can leverage their accounting firm. What I mean by that is, it sounds like you mentioned a couple of paths where maybe the accounting group, they do the payroll, or they help with the QuickBooks transactions, and there's a wide spectrum of, they're very much involved in the day-to-day, or just touching base, say once a month, helping with making sure everything is flowing through properly and answering questions. What are some of the options if someone wants to get connected with Lutz, just so they kind of have a lay of the land, or what are some of the resources and capacity out there?
Yeah, absolutely. We always have, our non-charge consultation meeting with any of our new clients. We talk through some of the stuff that we're talking through right now, because for people that haven't started a new business, some might be on here, some might not. But if you haven't had experience starting a new business, there's going to be a lot of hoops that you got to jump through that you're not going to be aware of. There's no way you would even know that you'd have to worry about some of the stuff that you need to take care of. So with a lot of our clients, we do that on that initial consultation. We'll work with them either on a monthly, quarterly, or semi-annual, or even annual basis, just depending on their needs, to kind of just check in, make sure things are running as they would expect. Meet on site. We do Zoom just like we're doing now, or we'll meet at the office, and just make sure that we get off on the right foot, because you want to make sure that, especially from the payroll standpoint, that you're off and running in the right direction, versus having to go back and fix a bunch of stuff that wasn't done properly right when you started the company.
Excellent. And maybe the last question I have for Michael is one I've gotten a couple of times. You mentioned it. For the employee, in the scenario it's restricted and there's the opportunity or the election for that 83B, how should an employee think about that? Because the scenario I've seen is, all right, they're obviously joining the company, so they're excited about it. But if it's a young, say a software developer, they might not have the cash on hand to pay that tax. So if you're advising an employee that's joining an early stage startup, what are some of the things to think about?
Yeah, I mean, that's a common one. In this example, it's $75,000 of income that they don't receive, so there's a tax associated with that. But there's other mechanisms that are out there that I think you can kind of have a net, so you maybe issue more shares than the company can buy those back. So there's ways that the sponsoring business can soften the blow there from a tax perspective. But it kind of boils down to a little bit that the 83B obviously works best. It only really works if the company goes up, but there's going to be scenarios in which the company fails, and how does the employee feel about taking that risk? Maybe they don't feel comfortable with that risk, and if so, that may not be the route to take. But we've seen the RSAs more so with founders, in terms of them kind of recapping along with the the different maybe classes of the Series C to the capital preferred stock, Series A capital raise. But it may be a little harder to convince an employee, to take that risk of forfeiture, and pay the taxes up front, which you may be paying taxes on value that turns out to be to nothing. So unfortunately, there's no magic bullet there, but it's something that it's not going to be the best fit in all circumstances, but it certainly may be, given the the company's prospects and the employees' propensity to participate in that journey of sorts.
Excellent. And I lied, last question. You mentioned about best tools and practices for payroll. On the cap table and the equity grants itself, obviously CARTA is a big one. Any other best practices or resources that founders should be looking into?
Yeah, CARTA is a good one. We'll do some of them, but there's a million on the internet that kind of offer that. I would say what we've seen is, you're kind of going to get what you pay for a little bit. There's some of these shops that they'll do it for a pretty low price, but, if push comes to shove and the IRS, wants to challenge something in the future, are they necessarily going to be there? I'm not sure. Maybe they will be, but that's kind of the downside with working with somebody on the internet that you don't really know that, they're out of New York or Dallas or whatever they may be. But there's quite a few firms out there that will do the work. And, the good thing, we'll do some of these 49A or 83B evaluations, and then you may pay a little more upfront, but then once the models are built, it's a much lower, ongoing expense, as you raise more capital, as you issue more shares into the future. So.
Awesome. Well, Michael and Jimmy, how can either live attendees or people viewing this after the fact get in touch with you?
Yeah, I guess I should have added our info on here, but we're on our website. It's Lutz, LUTZ.us. So, reach out to us or reach out to anybody at Lutz, and we'll be happy to assist any questions. And like Jimmy said, we're not going to charge, to have a conversation. That's not how we operate. So.
Well, thank you all for joining in live or watching us after the fact on our YouTube channel. We hope to see each of you July 20th, as I mentioned, for Nebraska Ag Tech Connect at Innovation Campus. And thank you again to Michael and Jimmy for taking time out of your afternoon.
Yep. Thank you, everybody.
Thanks, everybody. Take care.